So good morning, everyone, and thank you for joining our third quarter call. Join with me on my right is Kun Anucha, our Chief Risk Officer, and on my left, Kun Manop, our Chief Financial Officer. We also have a number of executives joining us online, including Kun Sarat, our President. He's online, and a few other executives as well. So if there are any questions, we can always try to answer them. So on this today, I think what we'll cover. Let me bring up the presentation. Apologies. So what we'll do is I understand that there'll be quite a few questions in terms of the kind of the credit portfolio, the relief program. So what I'll do is I'll give you a little bit of introduction and update on the program itself, where we are in the whole journey. Kun Manop will take care of the second section on the third quarter results. Then we'll leave some time for Q&A. The rest of the materials I think are for sort of at home reading. We won't necessarily have to go into details. And we have about 2 hours. Mindful of I think a lot of people have full day today with many earning calls coming out. So we'll try to end on time and maybe a little bit before, so that you can actually prepare for other calls that you will have coming up. So with that, and also let me propose that we'll do number one and number two in succession. Number one is a relatively short session, and then we'll do it together, and then we save some time for Q&A later on. So in terms of update, as we submitted the information last night, you probably already have it. Let me kind of, for the sake of for people who haven't seen it, let me kind of go through it for you quickly. As of end of second quarter, last quarter, we have a total loan of 839 billion under the relief program, or equivalent to 39% of our loan portfolio. At the end of third quarter, good thing is the number has come down to now become 29%, or 636 billion, or about 200 billion has come out of the relief program, which is a good number and higher than portfolio average for the country. Importantly, there's actually a limited amount of new enrollment coming in during this third quarter, in the order of a low single-digit billion compared to the net outflow. In terms of the ability to service debt, over 60% of our customers whose terms are due within the third quarter able to service the debt. So in that sense, it's good news. And over 30% of them need to resume some sort of payment assistance. We restructure some of the flow, and they are able to do that, but still they're still within our relief program still. So now within the 636 billion, we expect since the likely survival ones have already exited the program, so the remaining part we are estimating right now about more than 50% of them should still be able to service when in due course, and the other 50% might still require some sort of assistance. But of course, important to know that it doesn't mean that all of them will become NPL, for instance. That's very important. They require some assistance, and we need to structure appropriately the term. The one that actually you might also have questions around SME. SME, October 22nd, in a few days, there will be sort of the end of the formal program by BOT. As you already know, BOT has announced some sort of extension, I would say soft extension, where they give the discretion to both the clients as well as the banks to figure out what's the best program to support but it will not be a blanket support program like it has been in the past. SMEs for us is still relatively sticky, so in that sense we'll still need to be able to take care of them, and that's a segment where we need to pay close attention to. In terms of capital base, we remain strong, and we recently submitted BOT regulatory stress test, where BOT gave us a few scenarios, baseline scenarios, as well as the adverse scenarios. Glad to report that under both scenarios we would have far more than sufficient regulatory Tier 1 capital to support the kind of the downturn. So let me go a little bit into detail. On the left-hand side is the portfolio for the country, but more importantly, on the right-hand side is specific to us. So you can see that most of the reduction is actually coming from retail. That's from mortgage, from high purchase largely, and other segments are still in the process of sort of graduating from the relief program. And as you can see, SME still remains relatively sticky, but that's also because the timing hasn't quite hit the timeline yet. But we expect from proactive reach out that we have talked to the clients, more than 50% of the SME should be able to come back to kind of normal in that sense, and the remaining one should still probably require some assistance. And if you look at the recovery, while we don't have the information, but you can imagine that the recovery is relatively patchy in across the sectors, right? The sectors that are more domestic oriented tend to recover well, and 70 or 80% of the clients already come back. The sectors that are still depending on external tourism, export oriented, tend to still require quite a bit of assistance, and they are the one that's kind of sticky. Our portfolio actually has cut across the entire spectrum of economy, but we do have our fair share of tourism related in the corporate and SME segment. So that's why you would still, those are the segments where you need to pay close attention to, but also those are the segments where the country overall is trying to support. So therefore, in short, I think the most first and foremost in this crisis is that we prioritize the customer requirement, customer needs, because we believe that if the customers can get through the crisis, the banking industry overall, including ourselves, will be able to get through the crisis. So it's absolutely important to help the customers to the best we can. But also, we make sure that we are not putting illusion in front of ourselves. There are indeed certain segments and clients that ultimately will not be able to kind of service and unfortunately become NPL. So those are some of the customers that we pay close attention to, and you'll see later on that we take the qualitative NPL declaration on some of these customers, because we feel that it's quite important to also reflect the reality of the portfolio. So in that sense, and we'll get to that a little bit later on. But first and foremost, we definitely try to help the clients where if we believe that they can survive through this crisis. And in addition to the credit portfolio, we also help with other things in and around service in terms of helping with the sales, digital initiatives. We have some other platform that to help them. Robinhood and other things, and which we can get into the detail later on. The second one is around the risk management. As I mentioned, we will take a proactive stance now that we see the situation a little bit better in terms of how the portfolio will migrate. So in that sense, we're now taking proactive measure around qualitative NPL classification, as well as the underlying ECL or appropriate provision, which we'll get into that a little bit later on. You will also see, kind of the provision will remain vigilant, and we'll take a prudent measure to make sure that we are sufficiently provisioned and buffered for the uncertain future. So you see the number, we have escalated the number quite a bit in Q3. Finally, I already covered the stress test results that, we're not too concerned given the numbers that we've seen. But of course, situation is still highly volatile, and every bank is in communication with BOT in terms of how do we monitor, in terms of monitoring the progress and the situation. The current stress test, I think most banks are fine. But I cannot speak for other banks, but ultimately for us, we will well above regulatory requirement, and in fact well above our internal risk appetite statement for Tier 1. But of course, the situation remains volatile, and we'll continue to update you guys on the latest as we go. All right, so those are sort of the brief overview and quick update on the portfolio. With that, let me turn it over to our CFO to walk you through the results, and we'll save some time for Q&A later on.
Thank you, President Dr. Arab. Let me, so we are now on page 6 of the presentation. Let me highlight a few key features from our third quarter results. NIM still under pressure. We have done a number of measures to try to mitigate the impact from the rate cuts, but the net impact is still some NIM compression. The good thing is that we are seeing recurring fee income showing some side of recovery, even though this is still below the pre-COVID level. On the second point is that we notice a little resilient demands for mortgage and auto loans for the bank's targeted segments. This perhaps coincides with the progress of the relief program so far that we are seeing in the retail segment, whereby Dr. Arab just mentioned that the majority of our customers did come back and service their debts when their programs ended. We continue to maintain stringent cost discipline in the third quarter, and I think this should be the trend going forward. And this has resulted in overall rather solid operating profit for the quarter. If we strip out the one-off impact from last year, on the 9 months basis, we still see some decent growth in operating profit growth on a year-on-year basis. We have exercised prudent measures to ensure that our asset quality remains in check, and I will go into more details later. And very importantly, our balance sheet, our capital remains very strong, and we want to make sure that we keep our powder dry for any new opportunities in the future. On page 7, this is just to show the growth rate on the third quarter basis and on a 9 months basis. What I want to highlight perhaps is on the credit cost line, which we have seen the credit cost elevated from second quarter to third quarter. So in the third quarter, our credit cost was at 240 basis point. On a 9 months basis, it's about 200 basis point. The way we look at this is like no one can predict the eventual outcome of the crisis right now, nor could anyone put any time frame on the impact. So on the one hand, we have this uncertainty overhang in the market from the macro point of view. But on the other hand, we have the Bank of Thailand's relaxation rules, and very importantly, customers who need our assistance, which need us to be in a strong capital position. So right now we are seeing that the relief program so far has been stabilizing. So therefore we feel a little bit more comfortable to raise our credit cost a little higher, and this is just a matter of prudent practice. So that's why we are seeing this further elevated credit cost in the third quarter. On page 8, we summarize this page so that we do the comparison on an excluding one-off items basis, because in the third quarter of last year, we did a sale of our insurance subsidiary. So this is just to show the impact. Again, to highlight our pre-provisioning operating profit on a 9 months basis, the growth was 9% year-on-year. On a 3Q basis, on a year-on-year basis, is rather stable from the third quarter of last year. NAI on page 9, mainly because of on a year-on-year comparison, it showed a big drop because of the deconsolidation of our insurance subsidiary. Because with the SCB Life in our book, we did record NAI from investment in the NAI line. So we no longer have that. So that's a drop on the overall NAI. But nonetheless, if you look at the NAI lending, it's still rather stable on a quarter-on-quarter and also year-on-year basis. Now, NIM, we saw a NIM compression 8 basis point on a quarter-on-quarter basis. the main impact from the rate cuts is about 9 basis points. Rate reduction is about 9 basis points, and we have some mix and ER impact that add up to about 8 basis points. The extent of NIM compression, I would say, however, was milder than in the second quarter. In the second quarter, we saw a bigger drop in NIM from the first quarter. So we try to mitigate the rate cut impacts by managing our cost of funds and to a certain extent adjust our portfolio mix in order to minimize this impact. So on a full year basis, we still expect the NIM to be in our guided range of 3.2 to 3.4%, and we kind of see that our NIM should be somewhat stabilized at this level. Should there be no more further rate cuts or any intervention, policy intervention from the government. Now, if we dig deeper into loan yields, overall loan yields declined by 15 basis points on a Q-on-Q basis. Corporate saw a rather drastic yield compression from second quarter to third quarter, and this is basically a reflection of our strategy for flight for quality. So while yield drop a little bit on a Q-on-Q basis, we make sure that we are in the right segment. Basically, we want to allocate our balance sheet to the segment where we see the good, appropriate risk return profile. We saw also yield compression in the SME segment, and this is because mainly of the drawdown of the soft loan program, and the soft loan drawdown started mainly in May and June in the second quarter. So we are seeing the full quarter impact in the third quarter of this year. Nonetheless, we see a rather resilient yields in the retail segment, in particular auto sector. So that's something that I think is still quite positive. So all in all, yield compression 15 basis points. Loan growth. Our strategy has always been to be very prudent and direct our capital and balance sheet to the segments where we see appropriate risk return profile. So overall, loan growth for the third quarter, we focus on the year-to-date growth basis. So 2.7% growth year-to-date basis, and within this corporate we see 3% year-to-date growth. If you look at Q-on-Q, it's rather flat, but in fact within this flattish Q-on-Q growth, we're still growing our corporate loan, but just the fact that we also witness some recovery in the bond market, which has resulted in corporates coming back to repay their loans, and the loan demand may be softened a little bit from previous expectation. But nonetheless, going forward, we still believe that we still expect opportunistic loan demand for the rest of the year. So the overall loan growth, 3 to 5%, should be still be very achievable. SME loans growth is mainly driven by soft loan drawdown. Retail loans, this is some of the to us a little bit surprise on the upside. So we were talking about the loan growth page 12 in our presentation. So let me recap again a little bit. Our strategy has been very prudent and make sure that we direct our balance sheet to the right segments within our client portfolio where we see appropriate risk return profile. So total loan for the third quarter ending loan amount was 2.17 trillion baht, and on a year-to-date basis this is about 2.7% growth rate. And within this growth rate, we are seeing corporate loans growing about 3.2% on a year-to-date basis. 780 billion baht loan ending for corporate segment. Nonetheless, is rather flattish on a Q-on-Q basis. But what we want to highlight is that within this flattish growth rate, in fact, there was loan repayment, and some of this was actually driven by some pickup in the bond market in Thailand. So we need to build further loan to get to this flat growth rate. On the SME loan, the growth rate is mainly driven by the drawdown of the soft loan that we just mentioned, that we started to see this drawdown but towards the end of the second quarter. Retail loan, we got a little bit of upside surprise here in the auto and housing segments. On a Q&Q basis, auto loan growth was 3.5% and an uptick of about 1.3% Q&Q in the housing segment, in the housing loan. And we want to emphasize that for these two segments, which form a core portfolio of our retail segment, we mainly target the middle to upper high end of the market. So housing, we mainly target the top 6 developers in the country. For auto, we also have our preferred brands and also preferred dealers. So we just make sure that within this growth rate, we also maintain the quality. In fact, outside of our preferred segments, we have more stringent, more stricter criteria, underwriting criteria. On page 13, our new NPL for the quarter is almost 20 billion baht, so up quite significantly from second quarter. And we highlighted early on that the majority of this new NPL, in fact, about 2/3 of that is from the qualitative NPL. And within this qualitative recognition, the majority of that is from the relief program. The way we look at this is that we conducted a comprehensive review across all loan portfolio, not just a relief portfolio. And so this is based on customer risk rating and also customers' eventual debt service ability. So the purpose is to make sure that we try to have as appropriate stage classification as possible under the local rules. In other words, for the qualitative NPL recognition, we are trying to screen for customers whom we believe will be unlikely to survive given current economic environment. So after this review, we see the new NPL formation percentage upticking across the board, corporate SME and also retail segment, more notably in the housing loan sub-segment. So when we complete this review, we have some comfort in our asset quality in the sense that for the non-relief portfolio, we didn't see a significant natural NPL flow or NPL formation. So I think that does give us some reassurance on the overall asset quality. Credit cost, we discussed already 240 for third quarter, 12.9 billion or 13 billion baht for the quarter, up from almost 10 billion each in the first and second quarter. And if we maintain this at this level on the whole year basis, so we'll be somewhere around 45 billion for our provisioning level. But nonetheless, we want to highlight that given the uncertainty and volatile environment, we will determine and also to determine and make sure that our provisioning level reflects the true economic environment as much as possible. Coverage ratio declined a little bit from over 150% in the second quarter to 146% in the third quarter. And this is still above our target or our guideline of 130% coverage ratio. So we're still quite comfortable when our coverage ratio is still above 140%. Non-NAI, I would say this is our bright spot right now, and we have been trying to grow our fee incomes to make up for the NIM compression. Non-recurring non-NAI, non-recurring fee incomes on a quarter-on-quarter basis dropped quite a bit because in the second quarter simply we recorded quite a number of one-off items, derivatives, some of the opportunities deals that we did in the second quarter. So we kind of couldn't expect this to happen every quarter. So it comes out from 4.1 billion in the second quarter to around 1.6 billion in the third quarter. But what we want to emphasize is a pickup, a recovery in the recurring fee income, 7% year-on-year growth and 10% quarter-on-quarter growth. So we see our transactional banking fees recovering across the board, and even on the trade volume, while Thailand still sees significant pressure on the trade activities, trade volume. But I would say that we have outperformed the market, and that which should mean that we are expanding our share of our wallet in the trade segment. So this is quite encouraging, and we kind of see that this trend should continue in the fourth quarter. Some of this could be from the pent-up demand in the second quarter, but we believe that there is some recovery, gradual recovery to expect going forward. On page 16, then we dig deeper into recurring non-NII breakdown. Bank assurance is very solid. We end the third quarter at about 3 billion baht, and this is almost as high as 3.2 in the first quarter. Remember, in the first quarter, our performance was very strong, and it's kind of dropped in the second quarter. So the fact that we are still on a gradual recovery path, and the fact that we are in a very low interest rate environment, and we can still deliver close to first quarter numbers, that's a pretty respectable number in our view. Wealth management see some pickup on a Q-on-Q basis, 4% growth Q-on-Q. We try to manage under the volatile market, capital market environment in the third quarter, and we try to deliver or come up with more high-value investment products for our customers. So that's why we still see a rather solid income from the wealth management segment. And transactional banking, I mentioned already, pretty solid numbers here. So all in all, we believe that this fee income still has some recovery momentum. On page 17, cost. The cost agenda is at the very top of our management agenda. Given we have done digital transformations for the past few years, and most of the capital outlay for the digital transformation has already ended in the fourth quarter of last year. So we started to reap the benefits of the digital transformation. So for this year so far, we have managed to close down all physical branches, by about 10%. So we are now down at about 859 number of branches, and we managed to reduce our employees a little bit. So we see some reduction on the Q&Q in the employee cost, premise cost, and also marketing cost has ticked up on a quarter-on-quarter basis, simply because we have some recovery in the economic activities. But nonetheless, on a year-on-year basis, we still have a pretty good drop year-on-year. So on a full-year basis, we believe that our costs should remain on track to meet our internal target. Cost-income ratio, however, because of the some downward pressure on our income, so it has upticked a little bit to 46% cost-income ratio. Our guideline is in the high 40s, and that remains the case. We don't have any on page 19. Liquidity is a good spot for us. We continue to see that deposit that came in during the COVID lockdown continue to be quite sticky. So LD ratio for the third quarter, we operate at about 90%. Going forward, we kind of expect that there should be some outflow in the deposit to bring up. So the LD ratio should be going up a little bit. But nonetheless, our liquidity ratio, our liquidity condition is well above the bank targets. Capital is very strong. For the third quarter, we managed to appropriate the profit from the first half into our CET1. So our CET1 right now stood at 7.6% at the end of third quarter. Total CAR ratio is at 18.7%. So this capital position should be among the strongest in the banking sector and also in fact in the region. So Dr. Arak already mentioned that we have conducted the macro stress test, regulatory stress test, and the macro parameters that has been given to us by the Bank of Thailand is pretty much in line with our internal stress test that we did early on. So on the baseline basis, our CET1 should still be well above internal target. Even on the stress scenario, we still kind of see that our capital position will still be very high, well above the internal targets. Our economists forecast the Thai GDP to gradually recover. So on a whole year basis, we are looking at minus 7.8%. But we kind of see that the overall economic activities to return to the pre-COVID level by the middle of 2022. So we're looking at very gradual recovery pace. So that's why early on we mentioned that there's still lots of uncertainty. There could still be some volatility in the market. So there's a need for us to strike a balance between reflecting in our provisioning level versus our capital position. But nonetheless, our house view is that there will be no more policy rate cuts towards the end of the year. Some of the data, macro indicators already confirmed that we already passed the worst of the crisis in the second quarter. Now in the third quarter, we are already witnessing some picking up. So these macro indicators also are pretty much in line with what we are seeing in terms of our fee income, in particular the recurring fee income. We maintain our guidance for the whole year in this parameter. Credit costs over 165%. In fact, in 9 months, it's already 200%, and we still keep our guidance on this basis. So that will conclude my presentation, and we should have quite a bit of time for Q&A.